Well, hello everyone. Thank you for those who already joined and will be joining our important discussion on banks and fintech. Well, it's a collaboration that some have or has described it as the odd couple, each perceiving the other group as their own competitor. The question is that, does it still be the case in 2023? And if not, this is one of the topics that we're going to discuss deeply in our panel here. Of course, we're going to leave a few minutes for the audience in case you have questions, relevant questions to our discussion. But before we dive into our topics related to fintech and banks collaboration, let me introduce our shrewd panelists here. First of all, speaking is Hanan Ali. I'm the Managing Director of Sequence Consult, based in Bahrain. We're specialized in trade finance, Islamic finance, and their own fintech-related solution, mainly in the back office and treasury solutions. The fintech world has been introduced to me when I involved into the executive program in Harvard University. I've also orchestrated a number of fintech projects on a global level and also in blockchain. Next to me is Sujan Sanku. He's the co-founder and the COO of 99 InfoSystems, which is mainly functions or operates in Japan, US, and India. He's a seasoned professional with background in IT, finance, and law. He's experienced in merger and acquisition, program management, digital transformation, and green transformation. Next is Arnaud Wenger. He's also the COO, the General Counsel at Sakura Linkage International. He's also the board advisor and specialist of compliance and governance in fintech and payment, as well as traditional finance. Further as well is Brother Bander Alswailem. He's an independent board member and chairman of the Audit Committee in several public and private companies. He's in his last full-time role was the CEO of Yanal Finance Company in Saudi Arabia, and which is also an associate company of Orex Group in Japan. So, of course, we're going to dive more into the background of our panelists as we move forward in our discussion on this unique collaboration. We will start our discussion first on, of course, the 2020 lockdowns presented a very good opportunity for fintech companies. It was the year that fintech companies has blossomed, and the demand was at its peak for fintech solutions. However, moving forward from 2020, what we've witnessed is that the unrest situation at the global level. We've seen the collapse of well-known banks in the US. We have that sticky inflation, increase of interest rate, placing a huge pressure on venture capital funding, and also getting into the way of expansion plans for these fintech companies, and got the banks a little bit doubtful whether they're going to designate much more investment in fintech solutions. So how is the map of such a unique collaboration looks like in 2023? Let's start first, and I'll be addressing this question to Sujan, if you don't mind, to have your take in this map.
Thank you. Quite honestly speaking, VCs and PE funds, they're kind of dried up. They're not overly investing in fintech post-COVID. Obviously, neobanks and netbanks have kind of grown in popularity among the standard consumers. In terms of commercial banking, there is still interest in fintech solutions. It's very regional. There's a huge development in emerging markets, so to speak. Definitely Africa. M-Pesa, for example, it's a platform that it's not really pay-as-you-go. It's like You pay when you can pay. It's a very unique platform. It's not like credit where you just split it or you pay when you can pay with interest. It's for people who don't have a standard income or a what should I say, a steady income. So you basically base it off of your standard livelihood. I need X amount per month to live. I need X amount per day. So you use this, and it's a phone app. You just pay, and then you pay back to the service when you can. It's definitely something that I've never seen anywhere else in the world. Everywhere else, it's usually based on some kind of credit system, whether it's with collateral, whether it's credit built up over your salary being in the bank account, whatnot. But this is completely decentralized. It's not really government regulated. I think it's a very interesting fintech project, and I actually hope it propagates to other countries, because there are quite a few people who don't have a steady income, who live day to day or who live on the street. This would probably subsidize it, because the service works where people who can pay back, and then the service itself takes money from a regulated source. So the M-Pesa service actually has funding from a few African banks and the regulatory board in Africa. But the service itself is completely deregulated. So, and it's not like crypto or the other services that are a bit, what should I say? I wouldn't call it sketchy, but consumers tend not to like it too much. Obviously, in Western worlds, the developed world, they're willing to take the risk. So lots of people might have a crypto wallet. I'm pretty sure you probably have. You look like I also have. You can send me on Twitter. But so, like I said, neobanks and those kind of banks, net banks, are picking up in popularity. I also use it. It's easier for foreign remittance, anything overseas or cross-border. It's much easier than having a physical bank with the paperwork or something. It takes like a week to reach or receive. So I think it is still growing, but it has slowed down. Yeah.
So I could understand that majority of the investment is actually in this domain is actually moving towards payment across all the areas of investment in that domain. So Arnaud, would you agree that the investment is mainly in the payment solution rather than going through the deposits and fund or wealth management solutions?
I think this is different on the way, because fintech is very broad. We are focused on the payment solution, but to run a fintech and payment solution, you need also plenty of other services what tech can bring you. And to see how the banks are nowadays compared to 2020, for example, where everyone was, oh, I have an idea, let's invest on it and we will see what is coming. Nowadays, with the situation and the Fed is increasing the rate, and we can see this in Europe, banks are more scared to invest or to support VCs or anything. So we don't see so much investment. So now we need to see really who have the capacities to bring what we need. So we have one phase with the end user. They want facilities, they want to access to everything. You have maybe 3 bank accounts, you want to see all on the ones, so this is what open banking can bring to you. And on the other hand, you have also banks who have a lot of issues with more and more control and regulatory issues coming. Compliance is a very important point, anti-money laundering and fraud, which even if it differs country per country, we have a one stream. And this limits also the investment and the evolution of the banking from payments.
I would take more on this and just further on this topic, because yes, you're right, because the vibe as we speak, that we're witnessing a little bit of slowdown in the investment in fintech. If we were to compare, because these statistics are still not available for 2023, the investment in fintech in 2022 had been less by 30% compared to 2021. So we can see that there's a slowdown, but I believe that it's still, that's such a unique collaboration, still keeping on becoming a trend in 2023. There was also a survey that been done for almost 760 banks around the world. 56% of them said that we're still willing to invest more in the fintech. However, there will be a bit of a disparity in the type and the priority given to these fintech. Now, if I were to see of course, each of these two concerned groups has definitely an objective of having this collaboration. We have the fintech looking for some funding, of course, and whereas the banks are looking for innovation. I'll be addressing this question to Badr. Do you think that this is the best bet if such a collaboration happened between these two groups?
Bismillah ar-Rahman ar-Rahim. First of all, I would like to thank the audience who are still here. Thank you in believing in our session, and we hope to give you something worth your time. I believe the partnership between banks and fintech companies are continuing to grow, and both parties are looking for benefiting from each other. Banks, for example, they are looking for number of benefits. To start with is the improving their customer service within banks. Fintech companies, they are more customer-oriented, more customer-centric. So banks can take advantage of that in improving their customer service experience. Of course, increasing revenue. This is a very typical benefit for banks. They can tap into new markets, increase their customer base, and provide unique and different products provided by fintech companies. Of course, one of the main benefits for the banks is also to reduce cost. Fintech companies are naturally, they have low cost structure, and they can add a lot of value to banks and reduce the cost of operation. So, for example, a bank can, partner with a fintech company to outsource the back office operation with a much more efficient way. On the other hand, fintech companies also, they stand to benefit a lot from partnering with banks, starting from the access to customer database. This is a huge advantage for them. It gives them a boost to their business, gives them an opportunity to grow, and of course, access to financial resources. So that's always important for fintech companies and their startup. And of course, it gives them legitimacy and authenticity, let's say. So if they are raising capital or doing any kind of promotion, it's always good to be associated with a bank. Back to your question, yes, I believe this is a fruitful relation. Of course, it's always faced with challenges, regulations. Both of them are subject to a number of regulations, so they have to maneuver around these regulations and trying to find their ways. One of the challenges is also trust. Banks have to be able to trust fintech companies in their customer database, and that's not an easy thing for banks to let go, especially when the fintech company is a startup. They haven't proven anything, and it's a bit challenging for the bank. Of course, the possibility of a recession also is another challenge, especially if we are raising capital for a fintech company. So all in all, I see the partnership is in the positive trend, and I see a very good combination where each party add a lot of benefit to the other.
I think
Please
maybe
go
I can
ahead.
add some things about that. I see also a very important point between the bank, especially traditional bank, and the new fintech. Traditional bank have the structure and the knowledge. So they grown up with all the regulation and everything, so they have a back office, even if sometimes they outsource it to another countries for cost reason, but it's still within the group. And they have the structures with compliance, and they have already the tools to screen, to do whatever. So example, for fraud. Fintech have a technology specially dedicated to end users and bring something what the bank doesn't have. So they need to work together, because the fintech most of the time, or the payment institution, they don't have the money to invest on all the tools necessary to perform the regulatory control. So they have to rely on the bank, so it's really harmonized, and they have to see. Second point, why banks don't do by themselves most of the time is because they have an old system. And to upgrade an old system with a new technology, it's very difficult and costly. That's where new tech companies can bring also a new solution with API and connections, where you can plug whatever you want.
So I guess if we could also touch on the trust part, what we've seen in the Middle East, even if with the emergence of the neobanks, still that there's a little bit of carefulness from the side of the bank, and that actually attributed to the regulation led by the central banks. Here we have number of legacy players, banks, who have established their own digital arms. Let me give you an example. We have in Bahrain, GIB have their own digital bank called MEME. We have ABC's bank ILA and so forth. All of them being established as the digital arm of these legacy players for the sake of being under the supervision of the current player in the market. But however, why wouldn't we see much more of the engine of the innovation, more beyond when we've been back in 2020? Do you see, Sujan, that it's not going to be a competition, but rather we need to come together from a cost-benefit, from the cost-benefit analysis?
As a fintech company owner, it's a touchy subject, to be very frank. Lots of, like you mentioned, lots of banks, traditional banks, are cautious, but it's a requirement going forward because the demand, basically the customers are shifting towards these newer services. So the banks don't want to lose, so they're investing either internally or they're just buying out fintech companies. And buying out doesn't necessarily mean they're going to use those services. It could just mean they want to put their foot down and stop them out. So we actually just had this conversation over there. But some banks are more progressive, let's call it, and they're willing to adopt fintech technologies, incorporate it in their system. So they're buying smaller fintech startups to actually help their customers and increase profitability. But some of the even older, bigger banks would rather come together as like a conglomerate and buy out the startups that might potentially steal their user base and kind of wipe them out. So they would just overprice those services so that nobody can use those services anymore. So then it's not competition. Hopefully, if regulation kind of relaxes and we can access the database, the user database, and then there's no privacy issues, there are a lot of laws on both the legal side for data management, and then there's, like I said, privacy side. So if we can, fintech companies would boom on their own, but there's a lot of funding required, like really a lot of funding required. And then it's very hard to acquire new customers because generally speaking, most of the customers who actually have a lot of cash in their account are not too young. They're usually of a middle age plus, and they're quite satisfied with their standard banking services, with their standard checkbooks. They don't really look for this fancy OTP, I need my phone for everything, let me touch and go with NFC. They're kind of fine with what it is, and human habit, tendency. We don't want to change the way we're doing things, even if it's maybe more convenient, because then you have to transfer your money, change everything, sign up again, maybe get paperwork. So it's a very, very, what should I say, difficult area for fintech, I would say.
So I will address the next one, this next question to Arnaud. As we develop these solutions, there was a clear cut between the type of these applications, whether it's customer-centric applications, back-office applications. There's not, each of these applications were very clear and for what purpose they've been developed. Majority of the projects that have been, which the banks and the fintech come together, putting up their own forces to get them. Now, what we see and the vibe goes on saying that, hey, let's have these back office becoming also a customer-centric to become, or to, in order to deliver more personalized services. Could you shed light on that with regards to the payment solutions?
This is coming, so first where it comes from is because initially we had fintechs who have one product and we want to that. But you have this product, but you have plenty of competitors to do that. So you need to increase the services that you want. And you will say, okay, at the beginning, I was just acquiring services. I take your money from the consumer and I send it to the merchant, for example. But it's no longer enough because we have plenty to do that. What can we propose? So we will start to say, oh, let's do microcredit, let's do whatever, card services. And it starts to become more and more complicated because one service is limited and you can have small regulation. No, you need to have a biggest regulation. And when you start to enter in a credit, for example, you need to refer to a bank. In Europe, it's very clear, if you want to provide a credit, you need to have a bank behind, or a license, banking license, which most of the fintech cannot afford because it's very expensive. So you need a partnership with a bank. And it's even more that because in Europe, when you have a credit in one country, doesn't mean you can do a credit in another country of EU. So you need to have another partnerships. Then what has been increased is a microcredit. We say it's brilliant, we do that. Or we have the new system that buy now, pay later. But what we can see all over this fintech is crashing at certain times because it's very costly to get back the money. To give an example, when I give you a credit of 3,000 euros, you don't pay me back. What I will do is sue you. Suing you will cost me 5,000 or 6,000 euros. So most of the banks just give up. And what they do for fintech to do that, okay, you want these services, you need to back up by your own capital by 80% minimum. So you take the responsibility. And this is how we can see the development when we say about back office and regulatory is coming more and more complicated for fintech. But fintechs need innovations. And to go back to the previous question with neobank, you ask how they grow up. Neobank was creating a good idea like this, maybe 5 years ago or 7 years, where the legislation was quite low and it was super easy to invest. So they're very focused on customers, but they totally forgot the regulation of data protection, which increased a lot. Nowadays, and to catch up the customer, they just put very low price. You know, when you go to your traditional bank and say, I want to open a bank account, I want this, and it costs you $1,000, or you have 2% interest rate, blah, blah, blah. And the new neobanks coming and say, oh, we do everything for free for you. To who you will choose. But at the end, the neobank doesn't have money to generate money. They just catch clients. At certain times, you need also to think about the money, how to generate this, especially when you have the regulation is coming. And like I said, we discussed, compliance, anti-fraud is super costly. And if you make any mistakes, the regulator will just cut your license and you can do any more business.
Yes, when these two groups comes into collaboration, the clarity of the strategy of why they're coming together in such a, for example, a certain project to deliver. Badr, what do you see the challenge here? Is it the clarity of the type of product that they need to deliver? What might stand in the way of attaining the project, the objective set by these two groups? If you may address this.
I think it would be interesting to look at this from the same perspective as M&A. If there is a synergy that will come out of the partnership, that will always be beneficial and it will work positively for both parties. So both banks and fintech companies, they have to sit down and look at their strengths, their weaknesses, and their strategy going forward. What do they need? And then they try to shop around for the partner who fulfills the gap or fills the gap. And same thing applies for the banks. Banks, of course, are in a much stronger position to shop around. They can look at all the fintech companies and they can pick and choose because they have the strength and the power. So, and for a bank in particular, what do they want from this partnership? What is their strategy? Of course, not doing anything is not an option now, because this is the trend. Market is moving toward this, fintech era. And if you don't do anything, you will be left out. You will be in a bad position. So I think that's the key, or the key word in this is synergy, added value to both parties. And I can add something unique to Saudi Arabia in this aspect, where there is a trend of partnering between banks and finance companies to finance consumers or utilize the unutilized limits given by the regulator to finance consumers. So banks have a limit by the regulator, finance companies have another limit. So if a bank and a finance company partner, or if a bank establish a finance company, they will be able to finance the whole limit. So if the finance company happens to be a fintech company, then there is an immediate impact on the revenue and profitability of the bank and, of course, the finance company. Because instead of financing X amount, they can finance probably an additional 50% of that limit, maybe, or 40% by utilizing the limit available to the finance companies. One of the biggest example in Saudi Arabia is one of the biggest bank basically in Saudi Arabia who established a fully owned finance company, and they are of course utilizing the customer database, and therefore if you go as a consumer to the bank, you will be able to get the full limit from one stop shop. While previously, you had to go to the bank to utilize one limit, and then you go to the finance company to use another limit. So, a combination of fintech relation as well as utilization of limits that could be tremendous benefit to both parties. Of course, the fintech company, if it's a finance company, they have already a limit from the regulator, and they will benefit greatly from the customer database of the bank, and the bank will be passing customers to them, in a great number. So that is a trend that is happening now, and I think that's a very lucrative trend. And this is, back to your question.
Well, thank you, Badr. This is really stresses on the fact that the fintech and banks collaboration is actually sitting on three pillars: innovation, right? Funding, and the talent. This is where sometimes a little bit of disparity from one country or a region, where we see the engine of producing fintech solution is at its peak, depending on whether these three pillars are already existing in that region or country. Now, it's quite interesting that when banks and fintech come to a collaboration, they have another dynamic that they need to consider, which is the type of the solution for which they are trying to develop. If the solution is B2C, B2B, the purpose of that collaboration would shift somehow between investment or merely a acquisition. Arnaud, if you may give us more depth in that.
So in terms of, we have two strengths. We have the fintech who target B2B and a fintech who target B2C. Most of the time of B2B, what they are looking is investment from banks. So it's a partnership with investment, and we will grow together to access to the bank point and to this how they're going. B2C is a bit different because the panel of potential clients is huge, and we don't have it as a fintech, clients have. So the main strategy for fintech on B2C is have an example and exit to be bought by a bank. This is what they are targeting. But nowadays we can see some things developing also, and we are reverse of the situation is the banking as services that we call BaaS. And in this way is the fintech use the service of the bank for developing and increasing the market, which is another way of not necessarily selling your business. You use the bank as real partners and service provider, and no longer the opposite, where the fintech used to be the service provider to the bank.
So, which really get us to another question. Maybe Sujan may address this. Again, it's not only just the type of the application that is in question, but the type of the investment or the area, especially the remittances. How do you see remittances application, the application that has to do with remittances transfers, whether is it the bulk, is it all or majority of the fintech companies are having more and more leads from banks in that domain, Or are we going to see more of the track or the flow come into the other kind of solutions that has to do, let's say, for wealth and fund management?
Well, I'm an Indian citizen, obviously. So I think last year, out of 800 billion total remittance, I think about 100 billion was in India. That's like what, 12, 13%, 12.5, if my math isn't wrong. So it obviously has never happened before. It's the highest through
So
India.
I guess it's 1% out of the total, right? Or 1/8, I guess.
Yeah, it's 1/8.
1/8.
So that's huge. It's not really, it's never been a financial hub for that purpose, but they have something called UPI. It's actually being adopted out of India also. Quite a few of the, I think even in MENA region, there are a few countries that are adopting it or going to adopt it. So that would kind of get rid of the creditors, let's say MasterCard, Visa card, Xcard, there's so many of those companies. And it also kind of takes the banks indirectly out of the loop. You could basically send money from a phone number to another phone number or any kind of identification that proves it's you, and you can just transfer money digitally. Obviously, that makes it very easy for payment. It also kind of, there's no regulation in place for that at all because it's not from bank to bank. There's no SWIFT, there's no IBAN. It's just, I'm sending to you, you're sending to X. So it's kind of hard to have a trail. So I think there's a risk factor in terms of money laundering, definitely, because you don't know where it's coming from, you don't know where it's going. At some point, maybe you might put it in a bank and withdraw it, and if you need it in cash. But if it's going to stay fully digital, if it's a full digital wallet, I don't know how countries are going to monitor it for tax purposes and other purposes to run the country. I mean, you live in a country, so they need to tax you. Otherwise, the country can't run. And if you can't trace the people who live there, their own cash, I honestly don't know how they're going to tax, because I know the IRS is a very, very strict organization in the States. They try to tax my Japanese income, my Indian income, global income. It's fine, it's fine. If it's in a bank, they can trace it. Too bad. Japan has my number. They started something where they're trying to trace all your bank accounts, insurance, everything with one number. People are pushing back. They don't want to pay tax. That's a different issue, I guess. But this kind of loss of control, it's great for people, but I don't know whether it's actually going to be helpful in the long run. I think it's great, but like I said, if the country can't tax you, I don't know how the country is going to operate going forward. So anyone want to kind of add on that, maybe?
Just jump on the peer-to-peer model like you present. Yes, it's true, we cannot trust it, except perhaps if we start to use a blockchain technology or use something else, and you enter in the public chain. That's true, certain countries doesn't have any regulation about that, so you cannot control, and the government, usually they are not so stable or they have another revenue, so they don't really need tax for that. The problem is, you do that when you want to come back and reinvest this money in other regions like US, Europe, Japan, even Dubai is performing more and more control, or Singapore, you are blocked. And nobody will accept you because you are not able to justify the income. And that's we can see. Same for the blockchain, because someone asked me, we had a very good discussion about blockchain and payment. When you are in the chain, we can traceability of everything, it's the public. And someone told me, yeah, but when we do to peer-to-peers and with our portfolio, to my wallet, to your wallet, nobody will know it. But when you go back to the normal chain, we will see that, yeah, the gap at certain times. And we can guess that something have a problem. And this will be part of the compliance to investigate. But we have certain limits. And like you said, for the governments, usually if they don't care about something, it's because they have another way to generate money. You don't necessarily tax on everything.
In the case of Saudi Arabia, of course, there is a very strict environment imposed by the regulator, which is good for everybody. FinTech companies and others, they have to go through a very thorough process before they are live. And the regulator is providing them with sandbox and everything until they are sure of their strength and capability before they are given the license. But I'm not a technical person, but I would think since there is a mobile number in the transaction, somehow using the technology of the mobile operator, maybe there is another way of tracking these things. But this is not my area of expertise. But I would think something like this would not be let loose because the consequences could be tremendous.
And most of the time when you use mobile to peer-to-peer, anyway to perform that, you don't see it, but you have payment institution behind. So you have a traceability of the money at a certain stage, except it's really local and you do. Yes, but everyone, the advantage of digitalization is we have more and more visibility on what is happening.
So building also wider a little bit, let's take a little bit zooming out from Saudi Arabia. I mean, even the Middle East, if you look at the Middle East level, we have currently 9 fintech hubs. The oldest is the IFCs in UAE, which currently has surpassed 1,000 registered companies. I mean, fintech companies in the UAE. The latest was in Egypt, which was established last year. Because of the recognized gap in the banking services, however, we see, as you mentioned, all that the regulation are still the hot topic in the domain of and also holding into much of that collaboration and the potential that may get out of that unique partnership. Now, if we also can touch on a very unique trend, we may say, or we may also visualize here nowadays and can see it nowadays, that is fintech companies as an infrastructure providers, which is something that is, we haven't, I mean, maybe it's already there, but not a lot of people have perceived it, which is, let me just give you a more explanation of how fintech can be an infrastructure provider. What they do is that, and this is where banks perceive fintech as their competitors, because they will immediately provide their solution to the customer bypassing the banks. Do you see that fintech companies may be more interested to provide their customers a direct solution rather than going through the bank? Sujan, if you have something to say about that.
I have a feeling he might actually be more attuned to this,
yeah.
But like I said, it's not a regulated zone if it's fintech, usually. So there's a concept in Japan where you pay salary in a brown envelope. So literally, you get your salary, you walk out. It's done mostly in like restaurants or like, drinking places. I should be careful what I say. But so nobody actually knows how much is being paid. The transaction is kind of under the table. And so I think certain fintech, because they can quickly solve a problem that's at hand, it kind of feels like that to me. I shouldn't say this as a fintech company owner, but sometimes the regulation is a hindrance, because what we want to do is provide a service that's needed. So if there's a void, the customer wants it, we will provide it. If there's no regulation, there's no hurdle. But it also means that there's risk on both sides, the consumer and us as a provider. To avoid that, like he said, we should probably partner up with a bank, but then there's a lot of paperwork, a lot of red tape, and then we can't immediately deal with what the customer wants anymore. So it's a really hard balance to find. We're leaning towards the customer, the end user, at the moment, because we're not in a highly regulated country. Like, we're not doing this in US, for example, or in Europe. I think we'll be crucified. We'll be legally crucified in those countries. But obviously, we are rolling out in certain developing nations. India has Reserve Bank of India, which is quite strict, so we're not messing with that country either. But there are quite a few developing nations where it's perfect time to actually start, because it's young, banking is young. Like I said, credit is also a young system. They don't have like a FICO score or anything like that. So we are predominantly targeting those, and I think a lot of the fintech companies that don't want to deal with banks are shifting their targets to these emerging markets, because mature markets, it's just, the hurdle to enter is just so high, and it's honestly a pain. As an owner, I must say, it's not worth going through that trouble, the cost, the time. and you might not even succeed at the end of the day. So, if there's anything to add?
No, it's very clear. If you passing the banks is possible if you want to have if you have an e-money license, for example, and you have your e-wallet, and you can create your ecosystem, but you need to bring everyone to this ecosystem. If they are out anyway, you will have to pass by a bank. You have your, just example, you have your bank account and you have your money on it. You want to move on our ecosystem, you need anyway to top up your wallet with us. After that, if I'm on the same ecosystem, we move from my e-wallet to your e-wallet, and doesn't matter. But if I want to move back this outside or someone who is outside, I will need to pass by a new bank anyway. In unregulated, and that's why fintech, it's very important to know where they want to develop. If your target is just to be in a country where the legislation is very friendly, let's say like this, like Vietnam or this, and you just target this one and do nothing, just do how you want. You can do it. And that's why you can see plenty of crypto companies and using blockchain in these countries, because you can do whatever you want. You don't have regulation. If tomorrow you are targeting another countries where you have a regulation and cross-border regulation, you will be blocked. And if you have not prepared properly your system for that, your business is over. Because competitors who already took that in consideration will win the market.
So basically, it's very interesting that the fintech companies are looking for means and ways that they may have their own business model as quick as possible delivered to their customer. But which begs a question, I may address it to Badr, if we take it from the lenses of the banks now, do you see that there's kind of an attempt to pull the carpet from beneath the fintech companies and have their own solutions developed in-house? I mean, is there a philosophy of why they might be doing this? Are they seeing that would be best for them because things might be way more regulated under the eyes, under the supervision, and even might also track the fintech companies in terms of pulling their own talent to be also hired within the banking industry. Do you see that many of these banks may move towards that, or they may just simply shift the headache of developing these fintech and just entrusted in the hands of these fintech companies?
I think, yes, there is a trend, and it really depends on each bank's management and the way they approach things. The more they are, controlling and, threatened by the competition, the more, they make decisions on that aspect. I think the main success factor for banks in this area is to acknowledge the weakness of the bank. If they think that they can do everything better than anyone, then that's going to be a problem. And unfortunately, there are still such mentalities, not much, hopefully. But if you acknowledge that fintech companies are coming up with a lot of value to banks, then that would be the starting point to have a successful decision. Having the fintech company separately may have its regulatory complications. So partnering with a fintech company may be a good idea, but being a separate fintech company may also add some burden. So if a bank can acquire, as you hinted, a bank can acquire a fintech company and make it as part of the bank and work as a separate entity, and then utilize the advantages that are provided by the bank in terms of infrastructure, customer database, regulatory access and approvals and leverage, then that could work. But as long as they also give space to the new team to innovate and develop. If the purpose of the acquisition is only to control, and if you influence the bank's way of thinking on the fintech team, then it's going to be a completely different result.
Well, we have a lot of topics to discuss, really, but we're left only with 5 minutes. It's quite of a unique, this is why it's being called like the odd couple. I'll give the floor now to the audience, just in case you may have questions, and we'll be pleased to do so. Please, if you may also, do you have the mic already?
And when you just to repeat it for everybody else, basically, if you're a fintech company, you have to make money, which means that you have to have a bank account. You have to have a relationship bank account with a lot of microtransactions that comes to you, that basically goes into that account. So that, and also when people have an e-wallet and they transfer money back and forth and so forth, that money has to go somewhere. Is it just a digital currency? Is it, you know, how is that managed in terms of control on that wallet, and how does it deal with the banks? I just to clarify it, because I'm not into that space really a lot, so I just need to understand a little bit more.
So I think she mentioned a while ago, so not only payment systems, there are other fintechs, is financial technologies, just like a whole gamut, the whole range of it. For example, our company is working on it's more for M&A. You could kind of call it like an accounting with AI kind of thing. So it's used for financial due diligence. So we still receive our payments, I don't mind saying it, in JP Morgan and Chase. So we receive it in a normal American regulated bank. How we spend it is also probably with a credit card from that bank. So it's pretty straightforward. But if you're working on a remittance service, honestly, I know there are quite a few in emerging markets, but in regulated spaces, they have to be, like you said, they have to be tied up with a legit bank that has recognition from the country or the Fed or something. Otherwise, usually they get shut down. Some agency comes after them. So I think to answer your question, management of regular funds would still be going through regular. It might be a neobank, of course, but it's some regulated bank. We are not going to keep it like in cash in a house or do something like, you know, like a drug deal or something. We still have to keep it on paper because we are a registered company. We need to pay tax. There's so many things we need to, like you said, microtransactions. We need to pay other people pay us. So just because we're a fintech service, maybe we might be creating something that is still not regulated. How we manage our money still has to be regulated. That's, I think, the only way to do it legally.
Well, also, if you may, it might resonate to as simple as when you have some of the financial service providers, let's say PayPal, if you were to register your own account, they always ask you for a credit card, right? So I mean, at the outer shell, it seems like, yeah, it's open and all that, but at the backbone, it's already regulated. It has to be. But to what would be the extent that such a solution can be built up more to become more open, well, that would be as much as how the dynamics of such a collaboration are going to go, as well as the support from the central banks.
I'm a U.S. company, and I contracted a company out of India to do some work for me, and I had to pay them. So their solution was a website, without mentioning the names, where I'm linked to my account, and I don't know where this website comes from in terms of where's the origin, country, headquarters, and so on. And they have an account with them, registered to their bank. I pay in dollars, they get it in rupees, so into their accounts. It presents a lot of challenges on currency exchange, on the transactions, how's it, you know, all of that, and these kind of sites are popping up quite a bit, and it becomes quite dangerous because now you're linking your account, your credit card onto a website that instead of doing a normal wire transfer from my bank account to there, like a global transfer, now I'm going through this go-between, and you really worry about security on this. If you can collaborate on that a little bit.
Quick answer. I'm sure all of us have seen the VeriSign page, right? Most of us maybe have heard of PayPal. Honestly, it's not much different from that. It's just that it's probably a lesser known service. Like you said, there are so many fintech companies. They might have just chosen the cheapest option, so it's probably some unknown thing. I understand the worry. You might have used your credit card or your bank details directly. I had the same issue with PayPal. Like, my father never uses PayPal. He doesn't trust it. I think eBay owns them, or they own eBay, vice versa. So they're big, but still, it's not a bank, so you don't trust the service. There's WeTransfer. There's so many services out there, but I don't know whether the risks are that high. I mean, I'm sure your clients got the payment, right? Yeah. So
they got the payment. They just, do I keep my information on there? If I delete it, will it stay in the archive there? If somebody hacks in, and all of this, it just pops into the mind. And with now people sending, phishing emails and links, and it's just becoming more and more and more worrying and complex. Life used to be simple in my days, but now it's worrying.
Just to explain the process for you and customers, to customers and remittance, also in commerce, when you buy some things, you just see something, I send the money, I paid, you receive. And we think that is okay. In reality, you have plenty of actors between. So usually you have always at least, so it can be bank to bank. So very simple things. You have your bank account, you send to my bank account. And this directly, my bank account will receive the order from you. I collect the money, I put it, hand over. Nowadays, with cross-border, what is happening, we have more and more fintech interests and payment institution. And for that, we have two things. We have one corporate account for the fintech itself, which is our own money we generate and we put our income, tax, and whatever. And one segregate account where we put all the money of the customers. So you and all the people who pay for them on the website or through the wire transfer, we will receive these, we put on this batch. We have some reconciliation from accounting perspective, but this money is saved and controlled. And we send this to the bank partners at the end where it's going. So, of course, for users, it seems super easy. For payment institution, it's much more complex than we have this. But we have a control, and everyone in the loop has to perform this due diligence to know where the money comes from, where the money goes. And if we have a scam, it happens a lot. We had recently a case where clients said, hey, someone scammed my website and put just to pay on this place. And the payment institution didn't notice it. We noticed it that there's something's wrong because what we have registered initially is not the same IBAN at the end. So we were able to stop it. We throw the money, we can give back the money to you, and we will also inform the FIU and authorities to ensure that it will not come. And we can also inform AWS or all our system who was helping for the website. So yes, you can be sure that we have people who control and ensure that their money will not be scammed. I don't say that it never happens. Unfortunately, we can't see this, but we do our best to protect that.
I guess we have, maybe there's a last question. I just see that there's a question, last question. Sorry,
Okay,
you want to add? Okay, quickly.
Okay, I'm sure that it's a very short time, but very interesting topics. And now it's very trendy because always people, looking for a new way to transfer money, between people to companies and also between also business to business and business to government. But there is two. I will limit my questions to two only. Okay. The first question is about. We all know that it's very easier to adapt B2C type of fintech, solutions, like what we have seen right now, in different countries. Why it's very difficult, to adapt B2B solutions? Because I think, it's more important in terms of transferring a lot of business. Huge amount of solutions can be adapted in that way. The second question is. We have heard, a lots of things about, as you have seen or said already, that a lots of banks now acquiring and merging with small fintechs. So by end of maybe 5 or 10 years, if I'm very, giving some time to large banks, okay, to acquire all of these solutions, what is the future of this fintech? Okay, is it going to be vanished and being acquired with the big giant banks in the world, and then we cannot have anymore? So why we have to adapt it in the first place? Okay, thank you.
Okay, your first question about the reason for B2C to be more developed than B2B. I think one important aspect of that is the associated regulations. With the consumer, it is fairly easier to verify the person, his credit, his score, his history, and you can verify that with the government database and everything. When it comes to business, it gets a bit complicated. First, you have to look at his financial statements. You have to assess the credit, and you have to verify a number of things. Regulations require the lender to do certain steps, including physical signatory and physical attendance. One of the regulations require the bank representative to obtain the customer signature physically. So it cannot be signed and sent or uploaded. It has to be physical in front of each other. So I think this is one main aspect of one of the main reasons. The other reason, of course, is the size. Consumer business size is huge, and the cost of doing the transaction is much less than the B2B. So it makes a lot of business sense to the lender.
To answer on your second part of the second question, where we're heading with this. So basically, as you may see, that the future lies into two aspects of this collaboration to flourish. Number one is the banks themselves and the fintech have their own problems that they have to deal internally. So in order to be stepping forward in the future of such a collaboration, each has to transform their inner processes and their business model to adapt in a way that they become more agile and more receptive to the changes. So that's the first thing that they are working. A lot of them are currently working. The other point is that in the curve of where we started with the fintech and where we're now and where we're heading, we started with the pioneers in the innovation. Some of the banks have put forward and said, yes, we're going to start to have our own environment, a white rooms. This is something that they have developed, where this is a room where they have to innovate and think of what they need to deliver when it comes for digital transformation. The pressure is already on from board members that they have to go with a much full digital transformation. The other thing is that we have the majority adopters, or those who been a little bit lagging in where the market is heading, but they are now in the stage of becoming the major adapters. So a lot of these are heading into that ecosystem and they have no other choice. Now, less and less of these banks and fintech are the laggers. So the laggers are those who understood that they have either to collaborate to fasten their pace of getting into the market, taking more of the market share, and so if you may ask me, as we just mentioned at the early start of the discussion, it started as competitors, now they are collaborators. So this is where we're heading with this.
I think I can add something. We had a third trend is coming also more and more, is a consortium of banks going to buy or to collaborate with one fintech and this to take over. Because for bank, it's very costly to develop what fintech is doing. It's easier for them to acquire or to this. We see, and about consortium, we had a very good example nowadays in Netherlands where we have a local merchant payment which is called Ideal, used to be private, has been bought by a consortium of banks in Europe which have HSBC, BNP, and I don't remember all this, supported by the European Commission. And now, this company's Ideal is no longer just private, it's like institution. The only one problem we can see that this bank can kill the market because they will import their pricing for outside and their nice pricing for themselves to get back. But this is a new trend which is coming as well. And we can see that a lot also on a blockchain technology where banks try to be together because it's quite new, they don't want to be late, how they can work on
I
together.
guess we have the last question, please.
Actually, I'm sorry, we're actually way over time. I'm sorry. But this does show us that, one, we have so many experts in the room, and why I think you've just created actually several new networking opportunities for everybody. So I'd like to, again, have a big hand for our panelists here. Thank you for all that information.